US markets were closed on Friday, of course, thanks to the July 4th Independence Day celebrations. Both the S&P 500 and Nasdaq Composite closed at record highs on Thursday, although futures slid the day after. The Dow also rallied on Thursday, and on Friday, the Pan-European Stock 600 index closed 0.5% lower, clocking a marginal weekly fall. Germany's DAX was down 0.6%, and France's CAC 40 lost 0.8%. The ASX 200, though, rose 0.1% to 8,603 on Friday, with 8 of the 11 sectors in the green. The benchmark index posted a weekly gain of 1%. And the global MSCI index hit a new high on Thursday, but eased back just slightly on Friday. So superficially, at least, the market melt-up continues. And the fear index, by the way, was down to 17.48. But now, I do find it a little ironic that America was celebrating its 4th of July holiday, a moment when the nation is supposed to come together after a week that, well, demonstrated just how far apart its citizens appear to be. But here's the question, though. Has the economic impact of tariffs genuinely been less bad so far than just about everybody feared earlier in the year? Or is everything just happening with more of a lag? Most investors are probably expecting next week's end to the 90-day delay to April's reciprocal tariffs to come and go without any major drama, but I guess we'll see. As for the economy generally, the jury's out on whether we're still waiting on the worst of the tariff hit. The delay in China's tariff levels probably came just in time to avert a more serious recessionary threat. The latest jobs report certainly didn't point to the bottom falling out of the labour market, though if we're talking about time lags, this is usually the last place economic damage shows up. It's worth remembering that sentiment does remain fragile, and tariffs have clearly taken some of the wind out of the sails of the US economy. But I wonder whether markets have missed a key point. Unlike the period between the 1950s and 70s, when the financial economy was about the same size as the real economy, decades of financialization, where money supply grew faster than gross domestic product, means the financial economy is now somewhere between 6 and 10 times bigger than the real economy. So when Trump threatens Powell, chair of the so-called independent Federal Reserve, or Prime Minister Keir Starmer sends bond yields surging when he refused to back his Chancellor Rachel Reeves, who had proposed cuts to welfare spending, or the massive increase in government debt in Germany to pay for defence, or Albo turning to the private sector for growth, having stoked government jobs for years, you wonder if the game is up.